Good to go, Mark. Welcome here. Today's date is September 17th, 2021, and we have Mark Pearlberg, CPA and tax advisor.
Okay, thanks for inviting me, Dan. If you can pull up the slides, I'll introduce myself as we pull on the slides. So if you could upload those slides, and I'll just tell you what screen to navigate to there. But in the meantime, as you're getting that up, I am a CPA, certified tax coach and certified tax planner. My practice, Mark Pearlberg CPA, PLLC, focuses on helping real estate investors and business owners achieve financial freedom through tax strategy. So today we're going to talk about is how can we use real estate investing and tax strategies to help you achieve financial freedom. Now, Dan, do you think is there a way that we can see the screen here of the webinar slides?
Yeah, I'm looking. I don't see your email yet, unfortunately.
Oh, okay, let me hold up.
Did you send it to my intel.com address or my business address?
I didn't send it. I have it uploaded.
Okay.
Which one do you prefer?
Either one, whatever's convenient to you. Just let me know.
Okay, I'm going to send it to Good Martian Capital. Then
Good Samaritan Capital.
Sorry. Oh, Good Samaritan. It looks like
that's the best pronunciation of my business I've heard yet. Okay.
Good Martian Capital. If you need another name for an additional LLC, if you can honor me by naming that LLC Good Martian Capital, that would be fantastic.
Done.
There we go. Okay, so as the slides are uploading, and Dan, you'll know where to get to on that. It'll be easy. I want to ask you guys now, can I read in the chats here? Can we get some chats going here? I want you guys to tell me, how do you think we can use, how do we use real estate tax strategies to help you guys achieve financial freedom? Let me get some of your answers in the chat. And actually, let's back up a little bit. I want you to define for me, what is financial freedom in the chat. What is your definition of financial freedom? Now, it's not something I'm not sure if financial freedom is defined specifically in the Webster dictionary, but tell me what your definition is of financial freedom. Not having to worry about health and retirement costs. Good answer, good answer. No debt. Yep, I still got some student loan debt. Being able to spend your time however you'd like, Rochelle, right? No debts, all beautiful things that we can work towards. Now, if we're investing in real estate, we're probably gonna have some form of debt, but it's gonna be good debt. Don't worry, we want this kind of leverage because it'll help us out on our taxes. Automatic passive income is a beautiful thing, Ashish, absolutely. So this is what we can do for our clients here. And let's go to the next two slides down. And what we can do with real estate and a tax strategy at a high level here is we create tax savings. And those tax savings are, at the end of the year, allow us to have more cash on hand to, in addition to the buildup of equity, and all the other things that we can do with real estate, we get additional cash on hand in the form of tax savings that allows us to reinvest and buy more and more properties. And what happens when we buy more properties? We get additional tax savings that we can further reinvest. So we see kind of a compounding snowball effect by which we are building wealth and reducing taxes. So if you go to the next screen, you'll see the agenda. And so I want you guys, if you could put just, I guess I'll have Dan moderate the chat. And Dan, if you can, how do we do Q&A here? Do people raise their hands, or do we have like a Q&A section, or what? Okay, so I guess what we're going to do here is I'm going to run through.
Sorry, I was on mute. What we tend to do is we have people put it in the chat, and then I'll judiciously interrupt you. But if you want to do it a different way, just let us know.
Okay, that's fine. No, we'll take that approach. That's totally fine. And we're going to start going through the slides. Well, first, we're going to talk about the benefits of real estate tax strategies at a high level, and then I'm going to dive into the individual tax strategies. Next, we're going to talk about other opportunities involved in just taking advantage of the tax incentives and financial structures of investing in real estate. And then finally, we're going to do, well, I guess we'll do Q&A throughout instead, and that's totally fine as well. And then maybe we'll have some more Q&A. So let's go to the next slide and take a look at what we're going to talk about here, which is the benefits of real estate tax strategies. So one of the benefits is passive treatment of your income, which is less expensive than having active treatment of your income. Now, for a lot of you guys, when you buy your first real estate investment, it opens up to you for being a first-time business owner. So now we have a whole world of write-offs that are available to you. And this gives us tons of opportunities now. Even if you are a passive investor in a syndication, we can still write off unreimbursed business expenses. Let's go up for a little, let's stay on the prior slide. Also, we can offset the tax liabilities from your rental property activity with depreciation, and we can also create losses, and in some instances, we can use those losses to offset the tax liabilities incurred from our W-2 income. Now, generally speaking, passive income from real estate is in a different bucket than your active income from your W-2 job, but we're going to talk about some exceptions to the rule that may allow us to create losses from our real estate and use those to offset our tax liabilities from our day-to-day jobs and create refunds at the end of the year, get some of that taxes that came out of our paycheck throughout the year. So let's go to the next slide, and we're going to dive into just a quick discussion of passive income here. Now, if you start a business, your first $142,800 is subject to payroll taxes or self-employment tax. We use those words interchangeably for the purpose of this discussion. So when we do this, this payroll tax is just painful because you don't even get a standard deduction to offset that income. So as soon as you're making money, you're paying payroll taxes. Sometimes it's higher than your effective tax rate. And that payroll tax is in addition to your state tax and your federal marginal tax. So it hurts if you're starting a business. Now, if you are an employee, that 15.3% on your 142,800, half of it is covered by your employer, and then you pay the other half. So it's still in addition to, you're still paying some amount in addition to your federal and state taxes. And then once your income exceeds 142,800 for 2021, you pay an additional 3.8% in Medicare tax. But when you have real estate and it is passive, there is no payroll taxes. So if you are to have positive income from your passive activities, it is going to be taxed at a lower rate because we eliminate the payroll taxes. However, we can do better than that, and if you're working with me, we probably will not have any taxes on your real estate rental income in this current tax, based on the current structure of our tax code. So let's go into the next slide, and we're going to talk about some other opportunities. Write-off strategies. So you're a first-time business owner, you just got your first rental. Now we can write off our travel. Maybe you're going to go to the bigger pockets in New Orleans and you're going to have a blast. You're going to make great connections, but you're also going to be able to write off your flight and your luggage and everything else. We can also potentially have the opportunity to put our vehicle in the business and write that off. We will discuss that a little later when we talk about depreciation. And we may be able to find business purposes for travel that we normally want to do, maybe to visit our family, get our family in the business and get rentals in the neighborhood. And now we're writing off our drives to the beach. Meals, we can have business meals with our spouses and friends and colleagues as long as there's a business purpose for that time. So now when we are discussing real estate and we are in business, we can write off our meals. They are 100% tax deductible this and next year as an incentive to help revive the restaurant industry. How awesome is that? Home office deduction. Another strategy here is hiring your children. And I love this strategy because even if we can't take advantage of all of the exceptions to the rule that we were talking about earlier, we still want to put our kids in the business because this is what we can do. And it's a fantastic strategy for raising funds for college. You hire your children in your rental business. When you pay them, the first $12,500 is untaxed because of the standard deduction. They could put a nice chunk of that money into their Roth IRA. The Roth IRA grows tax-free. It is a better strategy than the 529C because you can use it for education or for their retirement, or you can pull the principal out tax-free after 5 years if the kids decide that they don't want to go to college or just save it for retirement. Supplies, now we have the potential to create supplies write-offs, and of course you can't talk about write-offs in real estate without talking about depreciation. And depreciation oftentimes will allow us to have cash flow positive real estate that operates at a loss when we file our taxes, because we have so much depreciation that even though more cash is coming in than coming out, the depreciation wipes out the taxability of our income. Let's go to the next screen and see what else we can talk about.
Hey, we've got a quick question. The question is do the kids have to be a certain age?
That's a great question. Yeah, that's all the time. So based on tax court cases, as far as doing active work, the youngest allowable age has been 7 years old. I have, and I'm open to the idea of doing baby modeling for your business if we can legitimately do it. We will have to research the fair market value of the baby modeling, but the typical answer people will say is 7 years old. However, as they get older, let's pay attention to their greatest skills and strengths and interests, and we will leverage them to put that in the business and pay them as much as we can, because now we can pay them the fair market value of something that they are really good at.
All right, I'm going to hold. There are a couple more questions coming in, but I'm going to let you go on in your presentation for a little bit, and we'll circle back.
Okay, cool. So let's talk about depreciation here. So when we talk about depreciation, depreciation is the expense accounted for the wear and tear of an asset. So let's say we buy a rental property for $500,000, and obviously this is a rental property. Some of that rental property is going to be land and doesn't depreciate, but the amount we allocate to the building will depreciate typically over 27.5 years, or roughly 3.6%. Now, if we put 20% down to buy this rental property, and we can only write off 3% of the building and not even the land, that's a long time to get write-offs that resemble our cash contributions and the cash coming out of our pockets. So cost segregation is an opportunity to front load this depreciation and get that depreciation faster. So what we do with a cost segregation study is we evaluate that rental property and we identify items in that property that are not quite real estate and do not depreciate quite as long as 27.5 years. For instance, the carpet's not going to last 27.5 years. Neither will the cabinetry or the blinds, ceiling fans, driveway, pool, deck. Lots of items such as those that will depreciate faster. So we identify and assign a value to those items, and we move up depreciation because we can now depreciate those items faster. Anything that we identify in the first year that the property is placed in service qualifies for bonus depreciation. Now, bonus depreciation, as of right now, is 100%. So we will be able to write off 100% of any non-real estate items that we identify in this cost segregation study. So I have had instances where clients put 20% down to buy the property, or sometimes even 10% down with a second home mortgage, and we're writing off sometimes as much. I've seen it go as high as 65% of the purchase price. I've also seen, my rule of thumb, just when I do my estimates, is 20% of purchase price, but we've seen it across the board, and it allows us to get more of those write-offs and when we buy those properties in year one. Another thing that qualifies for bonus depreciation, again, is if that vehicle that you put in your business is 6,000 pounds or more, that will also qualify for bonus depreciation if it is fully dedicated to the business purpose usage. Questions?
Abisha has a question, and this goes back to what you said about the Roth IRA earlier. Is it not the case that Roth IRA funds can only be accessed for retirement, or else you pay a penalty?
Right, so we can use Roth IRAs for education in addition to retirement. And we can also take the principal out after 5 years tax-free.
And then Joanne is asking, are depreciations the same for a domestic property versus a property in a foreign country?
So with a foreign country, you would have to determine what are the tax rules in that foreign country. So it all just depends on how is the tax code structured in those foreign countries.
And then Rachel is asking, regarding bonus depreciation, is that the first year the home is put into service or the first year that the item, for example, a new roof, is put into service?
It is the first year that the property is placed into service. And the roof would actually get a 27.5-year depreciable life.
All right, we're getting a few more questions coming in now. They've started rolling. Can you cost segregate or bonus depreciate a property that's already been in rental for 5 years?
Yeah, so you can. There's going to be a little bit less meat on the bone, and you'll have to evaluate what's the condition of the property and how much write-offs are we going to free up. You would want this to be a more expensive type of rental, because there are going to be the 5-year life type of property that we identify. We'll get some wins from, but it really just depends on the circumstances and what we expect the tax benefits to be.
Shailendra is asking, how is it determined if a vehicle is used completely for business purposes? What do you need to prove?
So in this instance, it really there's a little bit of judgmental decisions on how we best document this, but it really depends on your circumstances. So if, let's say, I have a client who's doing flips, and he buys a third vehicle that's a pickup truck for handling those flips, we're going to be a little bit less concerned about maintaining documentation if we know it's going to be at 100%. But I had another client. This client, his wife was a real estate agent, and she got all excited when she found out about this because she went to buy a new Land Rover for $110,000. But she also wanted to use that Land Rover for personal reasons. She wanted to pick up the kids and everything else. So what we did was we bought the Land Rover towards the end of the year, around the middle of December, and we maintained a personal vehicle, and we designated that vehicle just for business purpose. We got the beginning odometer reading and end odometer reading and tracked all of her mileage, and we were able to maintain the proper documentation to substantiate 100% business purpose usage, to write off all 110% business purpose usage of that vehicle and write off the whole $110,000 of the Land Rover.
Wow, that's great. That's a great story.
Mm-hmm.
May is asking, is there a maximum amount you can write off with depreciation per year?
So it's funny that you said that, because back to the Land Rover story, the client called me. He asked me the same question. He says, is there a maximum amount we can write off for bonus depreciation on this vehicle? I said, unfortunately not. I haven't heard of such a thing. He goes, I was kind of hoping you'd say you would, because my wife is using this to help to buy this $110,000 vehicle. I don't want to buy it. But there's not so much a limit. However, there's something called alternative minimum tax that will kick in, and it records your tax liabilities as though you didn't have bonus depreciation. And you're only allowed to take a maximum of $500,000 of losses against your real estate income against your active income, so that those limitations may kick in and reduce the allowable bonus depreciation.
Abisha is asking, does depreciation need to be recaptured at time of sale? Are there any strategies to avoid it?
There are tons of strategies. So the depreciation we take on a cost segregation study is recaptured even if we do a 1031 exchange. But the 1031 exchange will offset the straight line depreciation of the actual real estate, the items that were not identified in the cost segregation study. Some strategies can be creating losses from our other rental properties, and those losses, maybe we do other cost segregation studies and buy other properties. Those losses will offset the depreciation recapture, whether it's from the 27.5-year property or that non-real estate we identified from the cost seg. There are other strategies as well. For instance, investing with your Roth IRA. Once it's in that Roth, and if it's unleveraged account, we don't have to worry about them eliminating the 1031 exchange. It's all going to be tax-free. There are some other strategies where we're just looking at the full makeup of your income and looking at all the different business activities where we can plan for these transactions and eliminate or mitigate the tax liabilities of recapture.
All right. And Batla is asking Roth. Oop, the column just jumped on me. Roth principal can be taken out anytime. Only the appreciation is subject to the 5-year rule. Is that not so?
That's exactly what I said as well. So when we say appreciate the growth of that, we can't take out without any penalties, but we can still take the principal out.
All right. And this question might need more context to be answered, but what amount of taxes do you have to pay after you sell your property after offsetting taxes by taking depreciation, say for 5 years?
It really just depends on the makeup of all the activities going on in your on your 1040 and what kind of plans we have in place.
All right, one last quick question, then we'll cap it and go on. What's the cost of a typical cost segregation study?
It typically varies. I would say market rate, standard market rate for an average cost segregation study would be about 2,500. However, we do have opportunities to do them for a significant amount less for our ongoing clients. So we can do them for significantly less. If we have our current clients, we can run some algorithms that are backed up through audit support, and we can do them for under $1,000.
All right, I'm going to hold questions for a little bit and let you go on with your presentation, and then we'll pick them back up.
Great. All right, so let's get to our next slide here. And let's talk about how we can offset tax liabilities from our W-2 income with our real estate investments. So this should apply to everybody here. First thing that is available is what they call the landlord exception, the small landlord exception. So if your modified adjusted gross income is $100,000 or less, you can deduct $25,000 of rental losses against your W-2 income. When I say modified AGI, adjusted gross income, we're talking about it's typically going to be your salary minus your 401k contributions, minus your IRA contributions, and minus any capital and plus or minus capital gains or losses. Now that amount is phased out as your income goes, as your modified AGI goes between $100,000 and $150,000 at 50 cents per dollar. So if that modified AGI, which for most of you will just be salaries minus 401k contributions, if that modified AGI gets to 125,000, then you get a $12,500 maximum write-off. And if you are married, you don't double that amount. So most people who are married just can't take advantage of it. There's another opportunity, though, that we can actually use our losses that we have created through all the strategies I listed earlier, maximizing our write-offs, cost segregation, bonus depreciation, and being proactive. We can potentially use those losses to offset our W-2 income if either any of us or our spouses have the real estate professional tax status and materially participate in our rental properties. Let's break this down. The real estate professional tax status, in order to have that, either you or your spouse has to be full-time in their real estate trade or business. And what I mean by that is more than 50% of your working hours have to be dedicated to your real estate trade or business. And that has to amount to more than 750 hours. And your real estate trade or business could be a real estate agent, flipping, general contractor, wholesaling, managing the properties that you already have. These are all things that would qualify. And then the other part is material participation. Material participation is a certain activity threshold by which we participate and manage and oversee all of the operations. And basically, there's a 7-pronged test. I think we can go through that in another discussion, but we have to, if we self-manage, we'll pass that material participation test most of the times. You have to put in at least 100 hours into that, which you'll get with a rep status. And if we have those two elements, material participation, real estate professional tax status, we can now treat our losses as non-passive. This is an incredible opportunity. So to give you an example of how powerful this could be, I had a client where he made about $850,000 and his wife was a real estate agent, and the prior CPA didn't really recognize the tax strategies available for him, but he bought 4 rental properties, each around maybe $300,000. Prior CPA did the tax return, no errors. Client wound up owing $20,000 on his tax return. We got the return. We got a call from the client. Watch one of our webinars, and go to YouTube. You can see tons of content. And he said, "There's got to be something else. There's no way my accountant knows what you guys are doing." So we amended the tax return. We did 4 cost segregation studies. He went from owing $20,000 to getting a $70,000 tax refund. We saved him $90,000 on his taxes, just by taking advantage of real estate professional tax status of his wife and cost segregation, and obviously his wife materially participated. Sure. And a little more detail, his wife was a real estate agent. Another amazing opportunity that is often overlooked that I love is taking advantage of short-term rentals where the average length of stay is 7 days or less. Now, you guys should really listen up. If you guys want to start saving 6 figures in taxes, I want you guys to start taking notes and start thinking about this seriously. If the average length of stay for your short-term rentals is 7 days or less, based on the definition of rental activity in Internal Revenue in IRS publication 935, the average length of stay is 7 days or less. It is not rental activity. It's more kind of like a hotel. And if it's more like a hotel and is active income, then we can create active losses through cost segregation and bonus depreciation and a whole other variety of strategies. So we create losses from this. And now if we materially participate in this activity where the length of stay is 7 days or less on average, then we can use those losses to offset our W-2 income. So I had a client who had a cash flow positive portfolio of about 6 properties. We purchased we ran some cost segregation studies. He purchased a log cabin. Not only did we run a cost segregation study, but we evaluated the fair market value of the furniture that came with that property. And that furniture, like the TV and the sheets and everything else, came out to around $70,000. It was a high-end rental property. We wrote off about 36%, around $280,000 of the purchase price in year 1. As a result, the client didn't pay any taxes on his cash flowing rental property portfolio. He was worrying about owing money in taxes because he was profiting. But in fact, when we did his taxes, we were able to offset all of the federal tax liabilities on his 2020 tax return. He got a $60,000 tax refund. We qualified him for the child tax credit and 100% of the allowable stimulus checks from the pandemic. So if you make too much for the small landlord exemption and you can't get either you or your spouse to get the real estate professional tax status, you can look into investing in short-term rentals. Not to mention the margins are fantastic on those. Another way that we can use our losses here, and this is actually not to offset our W-2 income, but we can create some PIGs, which is an acronym for passive income generator. So let's say that you have interest in your cousin's restaurant, or you're a partner, you used to be in a startup. We have a client who used to be in a startup. We're expecting $500,000 of income here, and we are going to be able to use long-term rentals to offset that, because if you are non-materially participating in that business, if you are a passive cash investor in a business partner, then you can actually use your losses from rental real estate to offset that income generated from those other business activities. So back to the topic of how can we use real estate, does a tax strategy in real estate allow us to achieve financial freedom? We take advantage of these strategies, we create massive refunds, hopefully, and those refunds, we don't use them to buy Lamborghinis and fur coats. That frees up additional capital so we can reinvest into more properties. If, like my prior client, we get a $60,000 or a $90,000 tax refund for, that's close to or should be enough to get another deal and another property where we will run another cost segregation study. Any questions at this point?
Yeah, I think you answered, Alex had a question, and I think you answered all of it except for this part. If you are qualifying as a real estate professional, is this an IRS red flag?
I would not call it a red flag. However, if you have a W-2 income, it's going to be hard to qualify as a real estate professional, because we have to say that more than 50% of your hours are dedicated to your real estate trader business. Now, I had a client who had 4-year paternity leave from his job. So we tried to like make him work like 60 hours a week while on paternity leave to pass that 50% test, but we couldn't do it. So as long if you are full time as an agent or anything else like that, you're good to go.
Or if your spouse is, right?
Exactly.
Yep. All right. This would be a good question to address here. How did the husband save 90K with his wife being a real estate agent? Does that mean she had a loss of way more than 90K?
Exactly. So the wife was a real estate agent. However, she most of her activity was dedicated to purchasing rentals for their own portfolio. She closed a couple of deals for her friends, and she also spent a lot of time managing the rental properties themselves. So even though so she bought 4 properties that year, and even though they were cash flow positive, they put a decent amount in. And then again, the cost segregation studies created enough losses to create a $90,000 tax refund.
All right. And we've got a foreign investor question again. Does short-term rentals apply for overseas properties? I hired a real estate property management company, and I assume they want to know if your short-term strategy works for overseas short-term rentals.
Unfortunately, that is going to be domiciled to that country's tax code, and losses from another country are not going to offset your taxable income from this country. So unfortunately, there's not a whole lot of meat on the bone there. However, if you're interested in learning more about this, I have a webinar on my YouTube page with an international tax attorney, Patrick McCormick, who is incredibly gifted, and we talk all about structuring and strategies for foreign investments.
And here's a good question. Brooke is asking those examples, especially with cost segregation in year one, but what happens in year two?
Okay, so that's a great question. So we front loaded all of this depreciation, right? And then in year 2, we don't get as much depreciation, right? So there might be some current concern here. So this is what we have to do. As you can look at in the bottom bullet point, we want to activate this cash to buy more rental properties, and those rental properties will generate additional depreciation to help us continue at operating at a loss on paper. Now, some people may say, well, I want that depreciation later. Well, it's true. Freeing up the capital from immediate cost segregation studies, that immediate cash that we can get from it, will allow us to buy more properties and get more depreciation. And you also got to consider the time value of money. If we can get the cash now instead of later, get the write-offs now, it's going to be more valuable because we can put that money to work and leverage it in real estate.
All right. And I think that is all the questions. There was a question for your name and web page, and I dropped that in the chat for you.
Awesome. Yeah, and the final slide, I'm going to show you some more ways on how we can connect.
All right. Back to the presentation.
Awesome. So let's go to the next slide. Okay, let's talk about other opportunities here. So some other opportunities where we can take advantage of the tax code in real estate. And again, investing with our retirement accounts, with Roth IRAs and 401ks. Appreciation, growth in equity, and refinancing. So think about this. Not only your personal residence is going to grow in value, but all your rental properties will increase in value over time, and your equity grows as you pay down that mortgage. And eventually, we may be able to leverage that equity to borrow out additional funds to buy more rental properties. And we are not taxed on the growth in value of our properties until we dispose of them. Some other opportunities, if some of you guys are from New Orleans, so this might be helpful with the historical tax credits, but there are tax credits available. We have new market housing credits, historical tax credits, and energy tax credits. So all of these things may allow us to free up get additional cash funding when we understand and navigate the tax environment. There may be some local and state tax credits available for you as well. Capital gains treatments of the sales. Let's talk about, so let's say that you are investing in syndicated funds. First usually those syndicated funds will use depreciation and cost seg to offset the cash flow of those properties. And eventually when it sells at a markup, you are not going to be taxed as though it were your ordinary income. The disposition will get that favorable long-term capital gains treatment. And If you don't want to pay any of that capital gains, then we can think about 1031 exchanges. Maybe at the syndication level they'll do it, or maybe your own properties you could do some 1031 exchange to exchanges to defer the tax liabilities on those dispositions and pretty much swap into bigger and bigger properties. Any questions at this point?
We've got one question, and it is, can you recommend a resource that lists federal and state specific tax credits?
Gosh, that is a
I'd love
wonderful
to know that.
question. And if you email me, mark@markprobergcpa.com, I would, I think I can find you something, and that would be great. Most, and I'll tell you in advance, most investments will not qualify for tax credits, but it is important, it is nice to be cognizant of when we may have these opportunities, and they do arrive in certain circumstances.
Another question, do you have a Twitter handle?
I don't have Twitter, but you can find, I have a YouTube page, I have a Facebook page, Instagram and LinkedIn, and I try to put some valuable content on all of those sites. So if you find Mark Pearlberg CPA PLLC on Facebook, and yeah, so here you'll see, as far as next steps, if you want to get more information from me, I do have my Facebook page where I post all of my upcoming webinars and events, and you can find them on Facebook. All of my live webinars are free, and I try to do at least one a month, and they're interactive, and I'll answer all your questions as best I can. They're all recorded and uploaded to my YouTube page, and they can also be found on my website, markpearlbergcpa.com. You're also going to find some of my podcast guest spots on there as well. I have an Instagram page, and also as far as speaking of my live webinars, I have a live webinar coming up on October 7th at 7 p.m. The topic is 1031 strategy stacking. We're going to have a qualified intermediary by the name of David Foster. He actually might be a great guest for your show. But Dave Foster, and he's helped out a lot of my clients as well. And yeah, actually, yes, Pompey, I actually work with clients across the country. But anyways, we're going to talk about how we can combine a wealth building strategies, business building strategies, and tax strategies with the 1031 exchange and all sorts of different creative scenarios and different ways that we can use 1031 exchanges and reverse 1031s and multi-asset 1031s to really optimize our tax savings and wealth building abilities. So if you're interested in that, shoot me an email at mark@markpearlbergcpa.com. Also, if you want to get invites to any of my future webinars, anyone who emails me will be put on my mailing list, and I'll invite you to all my live webinars, and you'll be on my newsletter. I'll give you updates in the tax code or anything else that we're working on. We're going to start doing some advanced college planning strategies for our clients in October. Some really exciting things where we can save our clients tens of thousands of dollars on their children's tuition as well.
All right, guys, we've got a super knowledgeable guy with taxes here. Let's see your questions. And the first one is, what steps would you recommend to pay a child to help offset positive cash flow from a short-term rental?
Okay, so well, let's ask another question. How old is the child? And we want to find something. So here's what a lot of people will think about is, well, we'll get the kid to clean the office, get him to sweep the floors, and we'll pay him $10, $15 an hour. And I think that we're selling ourselves and our children short by doing that. So we want to really take notice of what our children are good at. What are their greatest strengths? Because if they are a math whiz and they can do financial analysis and books for us, we can pay them the fair market value of a bookkeeper. If they like gadgets, they can fly drones over our apartments. Or if they're teenagers, these teenagers are better than us at this. They can manage our social media accounts, so LinkedIn and the Alignable and all that stuff. So it really depends on their greatest strengths. And when we tap into their greatest strengths, we can justify a higher fair market value for those services.
All right, I think you've blown them away because I don't see any more questions.
Oh, here we got one. Any recommendation for Airbnb rental from an unknown user? So A lot of my clients love investing in the mountains because when they invest in the mountains, those rent out year round, so they're evergreen. So Tennessee, Smoky Mountains, I got a lot of clients just crushing it in Tennessee. But you know what? You'd be surprised in your own neck of the woods, you could probably do really well with a short-term rental. I did one in a rural area outside of Charlotte, North Carolina, and it did wonderfully well. I saw a question on podcasts. I'm actually going to be converting my webinars into podcast format in the next few months. So hang in there. If you're on my newsletter, I'll email you when those become available on all the podcast players as well. I guess I see another one here says, when can you say justify when you mean in case you get audited? You'd have to justify your expenses. Right. So one of the things we do with our clients is compliance coaching, and we identify, what do we need to maintain to substantiate our write-offs here? So we want to be able to prove that our write-offs actually took place and maintain proper records and documentation. We got another one here. Can you reiterate how tax savings are maximized when you or your spouse qualify as a real estate professional? Okay, so you only need one person to be a real estate professional. As long as one of you is a real estate professional, you can use those losses that you create through real estate potentially through cost segregation study, and you can use those losses to reduce your tax liabilities that you have incurred from your W-2 income. So let's say you make $400,000 and your rental portfolio generates a loss of $200,000. Now you only have a taxable income of $200,000, and we've reduced, and let's say your effective tax rate is 30%, then we save you $60,000. Okay, so if you're interested in my webinar, what you do is you just got to find the link, and when you register for the webinar in advance via Zoom, you will get a link and you will be reminded of that webinar when it comes up. And just send me an email, and then anyone who emails me will be automatically on my mailing list and invited to October's webinar on 1031 exchanges. See what else we got here. I think we're good.
Z Yang is asking, does the IRS ask for multiple years of documentation? How many years of documentation should I keep on hand?
You want to maintain 7 years of documentation.
And then Rachel is asking, building on your paying children, what records do you need to keep? Just a contemporaneous record of what they did and on what date and how much was paid to them, or is there or later to them?
I would err on the side of over documentation here. So think about how you would hire a contractor or an employee and really log their hours, have a job description, and as best as we can document the work that they are performing and that we are treating them like an employee. That type of records are going to help us with substantiate our write-offs when we hire members of our family. We want to consider the fact that this is going to be held under greater scrutiny than when we hire people outside of our family. But it is a very popular strategy.
All right, we've got a few more minutes here. If people have other questions. But in the meantime, let's everybody take yourselves off mute and thank Mark for all the advice he's shared.
Thank you.
Thank you, Mark.
Thanks, Mark.
All right,
Thank you
very
much, Mark.
This was wonderful. Thanks.
Yeah, thank you.
Yeah,
Awesome.
Yeah, thanks for hosting me, and thanks for the kind words, guys. And you see my contact information. If you ever want to hear learn any more about what I'm doing, follow me on YouTube and shoot me a quick email saying hey, and I'll say hey back, and then you're automatically on my mailing list, and I'll keep you guys updated on the latest and greatest changes in the tax code.
Wonderful.
Rachel is asking, if you pay your children up to $12,500, do you need to issue a 1099 or other form?
I've been, as far as reporting it, I would probably err on the side of caution and issue them a 1099 or a W-2. At the same time, I've heard tax attorneys say it's just an unnecessary formality, but I say I would do it.
All right. Well, it looks like Everybody has had their fill, and they're probably overflowing. So, Mark, thank you very much for coming here and sharing all this information with us. It was really drinking from a fire hose. And everybody that's out there, thank you for coming in. We're going to be back every week, as we always are, with new great speakers. Will the slides be shared? Mark, do I have your permission to share the slides? I usually post them internally.
Absolutely. Share the slides. They're free for you guys to use. I hope you guys found value of this conversation. I did jam pack a lot of stuff in here, so I'm glad that it's recorded and you can rewatch the recording, and hopefully you guys all got something of value out of this.
All right. Have a great weekend, everyone.
Yep. Well, and Dan, thanks again for hosting me. And anybody else that wants to talk, would love to hear from you guys and help you out as best I can. And you guys enjoy the rest of your day.
Next week, we have a person who went to prison, turned their life around, and is now coaching others in real estate. See you then.
Thank you, Mark.
Thanks, guys.
Great presentation.
Thank you.
Thank you,
Yes,
Mark.
thanks, Mark. Thanks,
Thank you,
Daniel.
Mark.
Bye. Have a nice weekend.
Have a nice
Thank
weekend, you
Mark.
guys.
Thank you, Dan.
All right. Well, I'm going to sign out. Have a good one, you guys.
See you later.
Thank you, Mark. Thanks.